Today's highlight. Bitcoin has dropped from 126,000 to around 89,000. In the midst of extreme panic, who will ultimately win this round, the bulls or the bears? Wall Street has been debating this for an entire year. Can the MicroStrategy model last? Should it be removed from the index? From traditional declines to embedded upgrades, is the decade-long buildup of cryptocurrencies really coming to an end? Monday, December 15th, this is the BitcoinTV Chinese channel. Be united. I'm Michael. Let's first take a look at the most important data summary from the past 24 hours in the crypto world. So what about Bitcoin right now? To put it simply, it's being pulled back and forth by the macro environment. This morning at 8 a.m. on Monday, we released an exclusive weekly review for our members. For the coming week, should we be reducing our positions or buying the dip? We have our own clear judgment on this. Right now, Bitcoin's price has pulled back from a high of 120,000 to a low near 89,000. The fear index has dropped straight down to 23, which means that even if people aren't saying it out loud, they're all panicking inside. The bears have some solid reasons too. For example, the Bank of Japan is planning to raise interest rates to 0.75%, which is the highest yen interest rate in 30 years. Historically, whenever the yen tightens, Bitcoin doesn't get hit immediately. The price drop tends to happen with a delay. US Treasury bonds are tightening and yields just won't come down. Globally, liquidity is being drained everywhere. So with deleveraging, that big sell-off on October 11th dragged Bitcoin down to around $84,000. But the bulls haven't given up. The Federal Reserve has already ended quantitative tightening, first injecting $13.5 billion in liquidity, and later it will inject up to about $40 billion. Institutions are starting to test the waters too. Vanguard has launched a crypto version, and US banks are allowing up to 4% allocation for Bitcoin purchases through ETFs. In the options market, bets are being placed on a rebound to between $100,000 and $110,000. As for spot funds, they're getting ready to bottom fish and absorb positions around 80,000 to 85,000. So this isn't a crash, it's just that policy and liquidity are squeezing the market into a very narrow range as it looks for direction. Right now, the most valuable signal for Bitcoin isn't about its ups and downs or the price itself. It's about whose cost is lower on-chain. The latest data is actually quite unusual. New buyers who entered in the past 1 to 3 months have a lower cost basis than the old players who have been holding coins for 6 to 3 months. Normally, the script should be that new retail investors enter the market and buy in at prices higher than the average holding cost of the old investors. On average, the new buyers usually pay about $2,500 more, but now the data is completely reversed. If we look back at Bitcoin's growth history, this situation has occurred 9 times. On average, this kind of scenario lasted for 145 days, during which Bitcoin's price fluctuated wildly, with a lot of volatility. At its most extreme, the cost basis between new and old holders differed by as much as $19,500. So is it a bear market? According to some data, it really is a bear market, but from a macro perspective, calling this a bear market is nonsense. It's more like a muscle cramp than a broken bone. The coins are shifting from people who can't handle the volatility to those with a lower cost basis and stronger patience. So, midterm holders haven't collectively chosen to sell at a loss. To put it plainly, the current market is holding back and building internal strength, consolidating and compressing sideways, rather than sliding straight into the abyss. No matter how wild the price action gets, the on-chain structure is actually quietly improving. Now let's look at the current Bitcoin derivatives market. To put it simply, it's a process of actively deleveraging. The Z-score calculated from open interest and funding rates has dropped to a negative 0.28. This signal is very straightforward. It means people aren't as bold about going all in as before. In the past, whenever this Z-score turned positive, the market would basically be pushed up by high leverage, so prices would surge quickly and drop just as fast. But now, it's the opposite. Leverage is exiting the market, and risks are gradually being digested. What's even more crucial is that all of this is happening around the $90,000 mark. This shows that the recent pullback wasn't caused by forced liquidations, but rather the market itself hitting the brakes. In fact, this kind of downward movement is actually a healthy reaction within the overall trend of Bitcoin. In other words, it's about clearing out those positions that are prone to liquidation first, so that it's less likely to trigger a chain reaction of liquidations later on. Simply put, while the current market may not seem very exciting, it doesn't look like something bad is about to happen. Instead, it feels more like the market is making room for the next phase. Alright, please give us a like and turn on the notification bell. Every like you give is actually a huge support for our daily update program. At 8 o'clock this morning, we released the exclusive weekly review for our members. What is the weekly review for? It's about looking at the past week and, on a weekly basis, assessing how we should position ourselves for the coming week, whether we should buy, sell, or if the bottom has been reached. We hope to teach you how to interpret technical indicators using the simplest, most repeatable metrics so you can develop your own market intuition. This is the most important thing. Keeping it simple, repeating it, and turning it into your own technique. That's the most effective way. All right, let's take a look at today's news. Today, we're focusing on MicroStrategy. At the 3 recent summits in the Middle East, the Bitcoin Week, Bitcoin MENA, and the Dubai Tech Summit, Michael Saylor was present at all of them. Why is he so visible lately? It's because there's been some news recently that Michael Saylor's MicroStrategy might be kicked out of the North American indices. As everyone knows, in the US stock market, the hardest thing about being in an index isn't getting listed, but being kicked out. MicroStrategy has basically put all its chips on Bitcoin, which everyone is aware of, and they've steadfastly stuck to a buy-only, never-sell strategy, what you might call a faith-based approach. So whenever Bitcoin fluctuates, especially when it drops, the stock price follows along like a roller coaster. Over the past year, the market has become increasingly volatile. Even Wall Street has started to have doubts. Can a company so heavily concentrated in Bitcoin really be considered a normal company in the eyes of the index? Now, it's no longer a question of whether its price will rise or fall, but whether it even deserves to stay in the index.
According to Reuters, Strategy successfully retained its spot in the Nasdaq 100 index during the latest annual review. This was the company's first assessment since being included in the index in December 2024. And it was ultimately not removed. This round of index adjustments will officially take effect on December 22nd.
Pretty indestructible. Our leverage is, in the range of 10 to 15% and now heading towards zero, which is extremely, extremely robust.
After the announcement, Strategy founder Michael Saylor stated on the X platform that he will continue buying Bitcoin until the market is silenced. As of December this year, Strategy's Bitcoin holdings have exceeded 660,000 coins, still making it the world's publicly listed company with the largest holdings. The largest corporate holder of Bitcoin.
There's going to be a lot of different business models, a lot of different products created, and a lot of different companies launched, and a lot of money made. There will also be a lot of mistakes made and a lot of fortunes created, and this is the chaos of the marketplace.
At the MENA conference, a very bearish announcement was made. From now on, these treasury companies cannot hold digital assets exceeding half of the company's total assets. In other words, for a company like MicroStrategy that is all in on Bitcoin, you must have at least half of your assets in revenue that the traditional world can understand. But don't forget what MicroStrategy actually does. MicroStrategy really sells software. Although MicroStrategy insists that they will keep buying Bitcoin until the market shuts up, I believe they're already starting to weigh this new rule. If the proportion of crypto assets can't exceed 50%, then how should software and Bitcoin be measured in financial terms? I believe that for these veterans of the financial industry, this is just a matter of adjustment, right? So in fact, what's in front of MicroStrategy isn't a major test, but rather how you should adjust your financial statements going forward. Over the past decade, we have to admit that in the crypto world, as long as you had a silver tongue, a PowerPoint, and could tell a good story, you could pump the market, create a narrative, and attract investment. But recently, CoinShares released a 77-page 2026 outlook that completely overturned this concept. For 2026, the keywords have shifted from revolution, disruption, and storytelling to whether you can make money and whether there is cash flow. Can it work together with existing systems? So when Bitcoin hit a new all-time high in 2025, it wasn't the start of another round of mindless speculation, but rather a very clear dividing line. Crypto is no longer trying to replace traditional finance, but is quietly integrating itself into it. When things like stablecoin settlements, RW tokenization, and on-chain dividends, real tangible upgrades to traditional finance, can actually be implemented and accounted for, these will become the main narrative going forward. So to put it simply, in 2026, hype will fade away and real-world usage will take center stage.
CoinShares presents 3 scenarios for 2026. In a bear market, Bitcoin would be between $70,000 and $100,000. In the base case, it would be between $110,000 and $140,000. Optimistically, it would exceed $150,000. However, discussion has shifted from price highs to systemic adoption. Key variables are concentrated in 2026. 4 major brokerages are expected to open Bitcoin ETF allocations, and at least one mainstream 401k plan may allow Bitcoin. More than 2 non-S&P companies will directly hold Bitcoin, and several large custodial banks will go live. On-chain custody providers will enter a substantive adoption phase.
So, the current crypto market is no longer in that phase where people are just enthusiastic about telling stories and hyping up expectations. Now, it's about stablecoins and RWA. These are the foundation. If we can bring highly liquid and standardized financial assets from the traditional world, like US stocks, onto the blockchain, that would mark the beginning of blockchain technology's application in traditional finance. You can take a look at what the current landscape looks like. Ethereum, for example. It's becoming more and more like financial infrastructure, right? And Solana, on the other hand, focuses on speed, showing everyone that there's also a speed option for financial infrastructure. What's interesting is that now, exchanges, mining companies, and VCs, especially Binance, which has moved to Abu Dhabi, are splitting into 3 business segments. In other words, they're starting to abandon the all-or-nothing approach and are shifting toward a stable cash flow model, one that can even be open to regulation. So what CoinShares is saying is very straightforward. When an industry starts talking about moats, profit margins, market structure, and competition, it has already moved past the stage of relying on hype to survive. So 2026 might be the least exciting year, but it's very likely to be the year that determines who gets to stay. Here, there are legends of getting rich overnight. And there are also carefully woven scams. This is a dark forest of chaotic development, but it also nurtures the hope of a path toward the light. The ultimate destination of faith is freedom. The endpoint of consensus is equality. Lipton TV will guide you through the fog to see the future, and together we'll gradually become wealthier. Google is flexing its muscles with the Zhuchangji quantum computer, and the quantum community is making waves. So why is the crypto world panicking? With its relationship with the US on the rocks and its economy in chaos, why does Venezuela still cling to cryptocurrencies? Let me tell you, every time Bitcoin's price corrects, aside from all the doomsday theories, the quantum threat theory always gets brought up again. Now, Google's Willow chip and the so-called Zhuchangji number 3 are all showing off just how powerful quantum computers can be. Then there's this opportunist called a 106Z, a venture capital firm which released a quantum threat report causing a stir in the crypto world. Meanwhile, the quantum community is also wondering if they could just snap their fingers and wipe out the crypto world. There's a big YouTuber named Josh Otten who posted a screenshot claiming that Bitcoin is going to drop to $3, and he said, "This isn't just speculation." He said that if quantum computers really do break private keys and transfer out Bitcoin, then dump it on the market, Bitcoin could truly return to its primitive stage. In my opinion, if quantum computers can actually crack private keys, it's not just Satoshi Nakamoto's coins that are at risk. No one's coins would be safe. A total Bitcoin crash wouldn't mean it drops to $3. It would go straight to zero. So in reality, the quantum threat is still very far from us, but everyone is caught up in the mood, the stories, and the comics. I've already run through the entire process for everyone in advance.
Dinner corner, computers quite a bit. The more I learn about them, the more I'm like, oh wow, that might actually work. You know, it sounds like crazy physics, but if what they're talking about really works, it would be devastating for Bitcoin if the early coins were liquidated.
Long-term holders believe that even if quantum computing triggers an extreme crash, a large number of veteran players would step in to support. And the Bitcoin network is resilient enough that it's unlikely to collapse instantly because of this. However, he also warns that around 4 million Bitcoins are still stored in pay-to-public key, P2PK addresses, including Satoshi Nakamoto's early holdings. Once a transfer occurs, the full public key is exposed on-chain, and in theory, a quantum computer with sufficient computing power could derive the private key from it. This makes them potential targets for attack. Fortunately, the current mainstream Bitcoin address structure no longer directly exposes the full public key, and this risk has already been mitigated in the new wallet system.
You see, everyone is already taking defensive measures, right? During the process of transferring and in wallet modes, the full public key is no longer exposed. So how could you possibly reverse engineer the private key now? Of course, if you're allowed to use quantum attacks, why can't I use quantum encryption? Adam Back's attitude is very straightforward. For quantum computers to truly reverse engineer private keys, the quantum capability would need to develop for another 3 to 4 billion years. So basically, people born in the 1970s will never see that day. By the time quantum computers become powerful enough to break all cryptographic logic, it won't just be the world of encryption that needs to change. The entire foundation of mathematical logic would have to be transformed. So the existence of a quantum threat isn't necessarily a bad thing. It forces encryption and the Bitcoin world to upgrade their security. It pushes us to build layer upon layer of protective nets around our cryptographic principles. Now let's turn our attention to Venezuela. In Venezuela, stablecoins aren't used for speculation. They are tools for survival, a means of daily payment, because their fiat currency, the bolivar, is devaluing every single day. Ordinary people have no idea what this regulatory agency is actually for, and no one has any confidence in what the value of the legal tender will be tomorrow. As for the banking system, all trust in it has been completely exhausted. Blockchain companies put it very bluntly. After more than a decade of being battered by economic crises, the people of Venezuela can no longer live without blockchain-based banking services.
The country's rampant inflation has hit the people hard, with low wages and a decrease in purchasing power. Most people try to get by amid a de facto dollarization.
Channel says the 2025 Cryptocurrency Adoption Index report shows that Venezuela ranks 18th in the world for cryptocurrency adoption and rises to 9th place when adjusted for population size. It is pointed out that, due to the long-term dysfunction of domestic banking channels, peer-to-peer transfers and exchanging for fiat currency have become the core financial services locally. On-chain data shows that over 38% of Venezuelan IP traffic is directed to global platforms, offering P2P functionality. In the absence of banks, crypto platforms have become a practical and accessible financial channel.
So, what kind of organization is TRM Labs? It was established in 2018 and is a US-based company that specializes in tracking funds on the blockchain, specifically providing anti-money laundering compliance services for institutions. Therefore, its reports are all B2B. TRM Labs has a clear conclusion. As long as a country is under dictatorship, its economy is stagnant, and regulators have not provided clear guidance, stablecoins will become an underground payment system in that region and will be integrated into people's daily lives. It is becoming increasingly important. For Venezuelans, stablecoins have never been a trend or a hype. USDT is simply a tool for survival today.
Eric Trump, Donald Trump's second son, summed up Bitcoin in one sentence: there will only ever be 21 million, and once they're all mined, no one can change the rules. Gold can still be mined in increasing amounts, but Bitcoin is inherently limited. It is precisely because of this irreplicable scarcity that it has earned its place at the global asset table. Adam Livingston said that ordinary people would rather use a banker's depreciating paper money for 40 years than spend 40 hours learning about Bitcoin. As a result, Peter Schiff just cut to the chase. He didn't even need 40 hours, just one look and he declared Bitcoin a scam. On-chain data caught another move by Wei Shen. Look on-chain shows that Wei Shen's address, Point H, sold off all his UNIKNC and 40 trillion DNU1 tokens 5 hours ago. All those scattered sales added up to 16,796 USDC. The market just asked, did he only buy $2 million worth? Aster's creative god Zhao Changpeng laid his cards on the table. Not only that, but after posting on Twitter, he kept buying. In plain language, it means he hasn't bought enough and is still at it. He didn't disclose the amount, but his attitude was written all over his face. Coinbase CEO Brian Armstrong bluntly stated that while cryptocurrency can improve property rights and the monetary system, it can't save the system itself. It's not a magic key on TV. Regulation and anti-corruption are both essential. Crypto is a tool, not a savior.
Alright, today in our Daily Soup, let's talk about trading. In the crypto world, there are very few people who can truly succeed in trading. And what ruins traders is never the price fluctuations. It's always your own emotions. When the market is going up, what are most people afraid of? They're afraid of missing out. You can't wait to chase at the very top, right? Everyone's asking when they can buy in. And when the price drops, you're afraid to cut your losses. Even when you know the trend has turned bad, you stubbornly hold on. So what about when the market is sideways? Then you're afraid of missing out on some opportunity, so you buy and sell frequently, treating transaction fees as tuition. In the end, you'll realize that your account shrinking isn't the market targeting you. It's your emotions making the wrong trades for you, again and again. Once emotions take over your trading, your rationality drops. The more anxious you are, the more biased your judgment becomes. The more desperate you are to recover your losses, the more distorted your actions get. The more you stare at the screen, the more likely you are to make a move at exactly the wrong time. So true experts aren't the ones who can predict the market most accurately, but those who can stay rational and calm amid intense volatility. They know how to filter out market noise, quiet their emotions, and reduce ineffective trades. Let your strategy, not your emotions, make your trading decisions. You have to understand that the crypto market will always be unstable, but your mindset can remain steady. Remember, only those who can keep their emotions in check can earn the highest profits in an unstable market. Alright, that's all for today's program. Here you'll find information about our membership benefits. We hope you'll join as a member and support us in making the channel even more professional. We also hope to lead our members to work hard together and gradually become wealthier. See you next year.